Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome this week. I'm Jeff Barton, and you are listening to The Mortgage Voice. The Mortgage Voice with Jeff Barton, that's me, is available on demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately. Anytime. On YouTube, we upload the video version of the show every week, so just search for The Mortgage Voice. You can also listen to the show on demand with your mobile devices via any of our podcast partners. We got a lot of them, by the way. Apple, Google Podcasts, Spreaker, IO, Clips, Spotify, Stitcher, and more. Plus, we're still available on traditional radio. We have 5 stations, 3 different states, in a number of markets, including in the Inland Empire of Southern California, Las Vegas, Albuquerque, and Lake Tahoe. And if you're out there right now and listening to the show, again, thanks for listening. Show gets a lot of interesting calls as well as feedback on what we try to do each week, which is entertain, but mostly give you information that is useful if you're buying or refinancing a house. The rates have been really the driver of what's going on in the mortgage market for the last 5 years, but we're going to see that really ebb in 2022. One of the reasons, of course, is the inflation and what the Fed's doing about it, and we'll talk about that in a second. But if you're sitting there and you're listening and you've had a bout with COVID, or you're one of these people who in their family have had a bout with COVID, you know that it drains the family, it stresses everybody out. So I was talking to Daryl here earlier about what I think is happening with this new variant. And the variant is in a lot more places than people are telling you. And one of the reasons why is because it's not as strong. It doesn't hit you as hard, but you do get COVID. So if you're sick or have the flu, and I think if you look around or see what's happening at work, a lot of people have the flu right now. Well, what is it? Is it Omicron or is it the flu? So if you are one of those people who don't want to find out because you don't want to get on a list and you don't want to quarantine, you'll just ride the thing out because it's not as severe. And I think that's really what's happening. As well as, man, people get depressed with this thing. It's just another variant, another thing to do, another year of restrictions or masks. I think you see a lot of pent-up frustration, a lot of anxiety within the marketplace. And I don't know about your house, but in my house, if there is anxiety, a lot of buying goes on. What happens with that buying is that if you've got millions of people with at-home anxiety or COVID anxiety, they start buying stuff. And a lot of what we see today via the lack of supplies or things coming into the U.S. has to do with this huge buying splurge that has gone on for over almost 2 years now, where people have bought and bought and bought and keep buying. The online buying, the at-home work atmosphere, all of this has led to this tremendous buildup of demand, and the demand is yet to be satisfied. So, as a result, stuff sitting on ships in ports, not yet at your store, drives up existing products even more. That's part of the inflation puzzle. And the reason I bring all this stuff up is because it affects your ability to purchase. It affects your ability to refi, because a lot of the money is going to other places. But for the most part, the concentrated effort to be able to satisfy this huge demand has taken, like I say, the name of inflation, and going up 6.8% last month, year over year. That's big. Nobody can ignore almost 7%, especially since it's been going north for the last 3 months, from 4.5% up to 6.7%, and that the Fed itself has changed completely the direction that they're going when it talk about inflation in general. Usually what we would hear is transitory. I have spouted the exact same thing, thinking that the things I was reading, and I go to all kinds of places, as you know. I go to a number of different sources, as well as continually research it and talk to people in the industry. Inflation itself was this pent-up demand, supplies on ships, can't get them to the marketplace, and prices go up as a result. Well, that's not really what it is. And and this is one of the reasons I bring it up, is because if it continues and if it becomes permanent, it chips away at your savings and your ability to be able to borrow money. Because when the Fed clamps down, when it stops the bond buying taper, or starts or continues the taper at double the pace, which is what's happening right now. We were at $15 billion a month. They were not buying. Now they're up to $30 billion starting in January. So that's going to end the entire quantitative easing program probably in March. And believe me, at $120 billion a month, that's a big deal when you're buying mortgage-backed securities and treasuries. It's what kept the rates so low. So as all of this is part of the psyche of borrowers out there, everybody can read a news headline. Everybody can watch Fox or CNN or NBC, CBS, ABC News, plus all the ancillary smaller networks, and see that this is a big deal. It's going to cool the market. Now, what does this really mean? It means that your interest rates are probably going to go up, right? Unless what I said last week happens, and we'll get into that too. So if interest rates go up and you're trying to buy a house, and as we all know, housing is still very tight, it won't loosen for at least 6 to 8 months, meaning that demand has to fall far enough so that housing inventory builds in the MLS or for sale by owner type categories, so you'll be able to go out there and buy a house. So you're in a tough situation where you're going to have a rising interest rate and you're going to have a very high real estate market in terms of either the resale or the refi. Yes, it's a problem. One of the things about inflation that people don't talk about is because when we talk about all aspects of inflation, we have to talk about some good things about inflation. What are the good things? One of the good things, that sounds like Chris Cuomo. What are the good things? He answers his own questions. So one of the good things is that inflation has to do with wages. If you're making more money today than you were making last year, that's inflation. It's inflation on your wages. And if times 50 million people, that's obviously going to make employers have to charge more money for the products and services they sell. I mean, it only makes sense, right? There's still a margin that has to be had by the business in order to remain viable. So if there's wage increase across the board to a company, an industry, hey, Daryl, did you see the hospital strike in, where was it? Was it downtown Los Angeles?
It was in a variety of places, but it's obscene.
Well, these people deserve a raise. If anybody deserves a raise, right, in the last 2 years.
Well, the fact that they have to go to that
right
extent to get some action and get people interested.
It's amazing. And they've really relaxed the requirement to everybody have shots, too. I mean, they've just said, hey, you know what, we need the people more than we need the shots being given. So,
and that's happening in a lot of the emergency services.
Yeah.
Fire people, police people.
Right. I mean, if we have, let's say there's 210 million people vaccinated, that means there's probably 105 million people who aren't, and probably only 70 million of them, that was the number I heard, are even eligible for vaccines. So if these 70 million people, if you've got, probably that means it's like 30%, 25% of the people out there aren't vaccinated. Well, you look at any profession, it's probably going to be that way in nurses and firefighters and cops and, all the things that we need in order to maintain a daily lifestyle that we have, i.e. good health care, people to come and get you if you've fallen down or gotten sick and deliver you to the hospital. All those people need to catch a break, right? They all need a raise, especially these hospital workers. And when we're talking about that in with respect to inflation, you can understand. Overworked, underpaid people get mad. And this is a group that we can't afford to get them mad because we need those people, absolutely. Now, if you're talking about a stockbroker, a banker, do we really need these people? You know what I mean? But they're the ones really getting the biggest raises of all. And the inflationary aspect on wage raising is a real effect in the marketplace. So that's not going away. So this inflation spin may be up to a certain extent and may have risen 7% year over year. It may not go back down. What's going to go back down is the unemployment rate. What's going to go back down is the supply chain issues. But the wage growth is not going down. And everything that entails within inflation, that's not going back down. So we'll get into a lot more of this later. I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening to the show. We'll be right back. show. Our show is available wherever you need it, whenever you need information, and you need it right away to fit your busy schedule. Hey, we make it easy. You can watch or listen to the show, find our episodes on demand from our website at themortgagevoice.com. That's right, mortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly programming is also available on YouTube. Jeff Barton, The Mortgage Voice. You go there, you can see hundreds of shows, as well as our daily LinkedIn, as well as our Facebook and other social media broadcasts that we do. We're in podcast form here, wherever you go. Podcasts include Apple, Google Podcasts, Stitcher, Spreaker, Podclips, IO, and Spotify, and more. So check us out at the website, mortgagevoice.com, and thanks again for tuning in to see the show. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in each and every week. If you do so, you'll see that we have sort of a pattern of what we try to do, laying out some of the macro, some of the larger stuff that's going on in the world, in the industry, as to why things happen the way they are. And then we try to really boil it down to get great people on the show who can talk to us about programs and what's going on at the local level, national level, in terms of loans. What are they doing, and how are they doing? From Orion, joining me again today, he's been on the show a couple of times, Justin Simpers. Justin, how are you?
Well, Jeff, how you doing?
I'm fine, thank you very much. Okay, so as I was saying, what is happening, and I guess more specifically, what's happening over at Orion?
Well, I mean, purchase business is what's happening. It's
Right.
purchase and cash out season.
Right.
And I from a market perspective, I don't see anything slowing down for a while. I mean, the COVID relocation effort is, I think, just beginning, in my opinion. So, I know values have shot up, but I don't see an end for that anytime soon. But, to combat that, like Orion has recognized and moved into the down payment assistance market heavily. And so, we have two DPA programs at Orion that are extremely hot. It's the Chinoa Down Payment Assistance and
Right.
the National Home Buyers Fund.
Okay,
So-
explain either one of those down to like what a borrower might need to qualify for something like that.
Well, on the Chinoa side, I mean, if the borrower has a 660 credit score or higher, there's absolutely no overlays. So, you would just have your standard 2-year income documentation like you would for any FHA loan, and you're talking about bringing in the 3.5% and an extra 1.5% credit for closing, really bridges that gap. So, 660 and higher scores, there's nothing extra that you need to bring in. And, the beautiful thing about our DPAs is we're fully delegated. Like they're not sending them out like the Cal HFAs are, going to a third party for an underwrite or, DTI overlays or anything like that. So you really, you're moving fast. And in this market, you have to be closing in 30 days or less, or people are just not going to take your offer, So, yeah, I mean, it's really hot. DPAs are probably, I do at least one webinar a day on DPAs and, how what Orion can do for the broker partners and in the end game, the borrower, So,
Right.
yeah, they're hot. That's the hottest ticket. And, speed is the name of the game, and so having the speed to close in 3 weeks on a DPA is really, really, really good.
That's
So,
phenomenal.
Yeah.
3 weeks for a DPA. And people who don't know that, who are listening to the show, may not understand it. This is 2 loans you're doing. This isn't not just 1 loan.
Yeah, it is. And in fact, 90% of them know, the ones that we do are soft or silent seconds with
Right.
no payments due on the second. So, yeah, I mean, it's really strong, it's just, angling the borrower to, come in and when the market's hot, and it's hot right now, that and, Orion has also rolled out a super aggressive DSCR program, which is
Right.
the debt service coverage ratio for investors. And it's hot. Those are the 2 hottest things we have going.
On both of those, on the purchase side, what are the down payments that you need? Obviously, for the Chinoa loan, you don't need any down payment, right? But on the
Right.
DSCR, you do. What is that down payment?
15%. So they're going
Okay.
up to 85 LTV.
Well, that's
on
good,
that,
too.
Yeah, it's strong, and they'll do, 660 minimum scores. They'll do gift funds for purchases on an investor property. They do no ratio programs. They have, IO up to 40 year.
Wow.
So there's plethora of different angles to work with that. But yeah, those are two hottest items.
Now, shifting to these things, these kind of programs, which are dynamite, they're all exciting kind of programs, but they target a certain borrower who hasn't been able to get into the market in a traditional sense, right?
Right. Yeah, I mean, they're dealing with borrowers that don't qualify for, a full doc loan, or, borrowers that want to purchase a property in the name of the LLC,
right?
To keep it on that side. So yeah, I mean, it is definitely filling a lot of holes that were in the market that haven't been here since 2007.
Right.
So yeah,
I agree with that. I agree. I think all of that stuff that you bring to the market reminds me not of the quality, but of the type of product that's needed in the marketplace, and really hasn't had a chance because. Is it because refinances are drying up? Is that we're pushing the market towards a place whereby additional borrowers are needed? Or is this just a natural progression of what's happening because the paper's been so good?
Well, I think it's both. I mean, I think it's both. And yes, the refinances are drying up a little bit, but rates historically are still at, all-time lows.
Yep.
Like, you could look at it any way you want. But, yeah, I mean, yes, because the majority of the market is refinance, but still, Orion's been a purchase business, and our whole model's built on purchases like, TBD approvals for borrowers that's to be determined, for borrowers that are shopping. But I mean, I have seen, when the rents went up and, that and inflation with the rents, that's one of the reasons why the DSCR has become so hot, so. Yeah, I think that it is a combination of many factors, but it is definitely here to stay. So, it's funny, people ask me, like, well, what do I need to submit an application on a DSCR? And I'm like, well, Social Security card, ID.
Right. The 6 things, it's pretty straightforward.
Yeah, assets and identification, and that's it. So I love this loan.
Now, on the DSCR for a vacant building, do you go by what the appraiser gives you as a list of probable rents in the neighborhood and go 75% off that?
Correct. Yeah, and in fact, we have people that are wanting to buy, Airbnb, which is a hot new thing. Can you do that on a DSCR? Yeah, you can. You're just going to go with the market rents for the area that the property is located.
Right.
And they also got to keep in mind too, like, we have a no ratio qualification as well, which means we're not even, we just want to know that the property can breathe rent, I don't need to.
Yeah, that's funny.
So it is strong, definitely. Definitely strong.
You're one of the few people that I noticed. Now, we have a very large industry, as you know, and I've noticed several companies laying people off. But regardless, your particular online presence is great. It's terrific. I see a ton of it, but I don't see a ton of others doing it. Do you like doing it? Do you think it reaches enough people? Is the education that you provide to people through either LinkedIn or Facebook or whatever you're doing it on, is it something that you find is helpful to your business?
I do. In fact, my wife is credited for this, but I started it 3 years ago. And, my volume over the last 3 years, now I'm talking before COVID too, it tripled, my volume tripled it. And it's, top AE in the country per Scotsman Guide and all those things. And yeah, I mean, I would attribute a lot of it to, just being out there and, putting my videos out there and being, vulnerable to everybody, but keeping my name out there. Yeah, most definitely.
I heard you sing a song the other day, and it was, I don't know if you remember what it was. Oh, you do. You're laughing. Okay. So, and it was very clever. I enjoyed it because it was, the silliness of it made it even more impactful. As I'm listening, I'm going, oh, this is clever, and people will watch it. And I think that kind of embrace, without embracing the seriousness of it all, even though we're talking about very serious stuff, is part and parcel to how you are perceived, at least by me, in the marketplace. And it's a good thing. I don't think it's a bad thing.
Right. Yeah, I think, and that's why my wife, it's funny. People have asked, like, do you rehearse? I'm like, no, I don't rehearse. I write a note down, and this is what I want to talk about, and I just do it. And it's funny because my wife was the one that wanted me to do it because that's typically how I am at home. Just a goofball, but I can talk business, but I have fun doing it. You know, so.
Hey, listen, we're up against it. Shout out a phone number, a place by which, or somewhere, email, text, something that people can get a hold of you by.
Yeah, it's first name, last name, justinsimpers@gmail.com is my Gmail. You can go to the website at justinsimpers.com to see any videos. My cell phone. Anybody want to call up just to talk? Cry on the shoulder. It's 949-310-3750. But thank you, Jeff.
Hey, Justin, thank you very much. Thanks for coming on the show. You're a terrific guest, and I always appreciate you doing it.
No problem. Thank you so much.
Okay, that's Justin Simpers from Orion Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Look, check out our website at themortgagevoice.com. There you can find our latest on-demand episodes of The Mortgage Voice and information about our guests as well as their contact information. A lot of people, they listen to the show, they want to talk to the person that was the guest. Go to YouTube. There's plenty of stuff there. Go to themortgagevoice.com. Plenty of stuff there. You can find information there as well as many other places about the show. We have a blog. We have at themortgagevoice.com. A whole bunch of great stuff. I'm Jeff Barton, your voice. Thanks for tuning in. We bring to the show all the time. We do the macro and then we do the micro. The micro is about lenders, about people who can actually tell you exactly what you need to get a loan and the products out there in the marketplace. And joining us today from Logan Financial, once again, is Kurt Lehman, who is joining us. Thanks, Kurt. Thanks very much.
Wonderful. Thanks, Jeff, for having me.
Thank you very much. Okay. For people who don't know Logan, tell us a little bit about it. I know you've been on the show before. You have great products. We're currently doing business at Malibu Funding with you guys, so we're really appreciative. But tell us about Logan and some of the products that you're now offering.
Yeah, absolutely. So last time I was on, I think we had just got you guys signed on as a partner. We were new to the space. We had just been purchased by a large fund and have had just incredible success and growth. I think we're up to probably over 70 employees now.
Great.
And specialize in the non-QM and non-agency space. So we're talking about bank statement loans for self-employed borrowers, debt service coverage or investor loans where you qualify off the rental income, and then a lot of full doc jumbo and or interest-only type loans. So great rates, down in the low threes to fours typically is where we're playing with those, and having great success of building out, helping folks like yourself that are in the broker space get these products out to the borrowers.
I have a question just quickly about that DSCR. Let's say you have a fully rented out unit on a month-to-month, and the tenants will be given notice to increase rent after the building is purchased. Which do you use for the qualifications of the borrower? The rent current or the future rent going to be?
Well, we could look at the future rent if we have an updated agreement for the new tenants, right?
Right.
But one of the things that you definitely have to look at, Jeff, is the appraisal. We get what's called a 1007 rent schedule.
Yep.
And that will also factor in to what the rent that we will use when qualifying the borrower. So again, you take your rental income, and on an interest only, we can do it off interest, taxes, insurance, and association dues for qualifying. On a regular non-interest only, we would go principal, interest, taxes, insurance, and association dues would be how we would qualify.
Okay, excellent. Because you know what sellers do when they're selling their properties? Yeah, these are our rents, but they're not market rents, and they're going to be. And so a buyer comes in thinking that he can use that as a qualifier, and yet they run up against either an appraisal issue or that the lender won't look at something that hasn't happened yet.
Yep. Yeah. So typically that's where the appraisal comes in.
Right.
Is kind of the rule of thumb that we're using for the most part. Every situation's unique and different. We'll look at it whether they have Airbnb rental income,
Right.
or a tenant in the property. If the tenant's remaining in the property, or you're having new tenants in, as rents have increased, as you pointed out. So, we'll look at it from many different angles. We call ours our American Investor Program.
Okay.
Typically, if you have a 700 credit score or better, you're not going to have to put more than 25% down, and getting, like I said, some pretty strong rates in the high threes, low fours. So good ability to cash flow if you're an investor.
Well, obviously, in that non-QM space, and you're alluding to it right now, each borrower is unique. This isn't a cookie-cutter loan that you send to many, many different lenders who basically run it through some automated system and get your loan out in a certain amount of time, and that's their push, right? For you guys, it's about customer service, one loan at a time. Let's take the scenario as it comes in and underwrite it manually. Is that what happens pretty much?
Yes, that's correct. For the most part, it's not your Fannie, Freddie,
right.
Or even your FHA, VA type guidelines where a number of people are fitting into those. This makes up right now only probably about 6% of the total mortgage market, but it's growing significantly, as we both know.
Yep.
More and more people are finding out about it, and loan officers such as those on your team are starting to get familiarized with the products and getting them out there to let real estate agents know, let borrowers know, and it's very helpful to get folks this type of financing, whether you're a self-employed borrower or as we talked about, the debt service coverage. And we're closing them fast. The nice thing, what we've done is we've streamlined processes. We're working with the best of the best, such as Malibu and you guys. So folks are having great success, closing in 15 days or less on debt service coverage, and definitely within 20, 25 days or less on business bank statement type loans. So.
Okay, let's put on your prognostication clothes and tell me, where are we heading with the rates? Where are we heading with products? Are we going to see much more of a reduced overall market simply because rates are going to rise too fast, or do we see this sort of playing out in a long, slow rise?
Yeah, that's why I, have staked my career moving into the. I've been 20 years as an account executive, helping brokers, bankers,
right.
credit unions and banks, and
right.
all that stuff. And that's why I've positioned myself in this non-QM space, is I think it's going to continue to build expansive programs. It's not subprime.
Well, okay, tell us what the difference is, because a lot of people don't know. And
so back in the day, subprime was definitely a lot lower credit scores.
Right.
Up to 100% financing at the time, even with low credit scores.
110, 125 sometimes, yeah.
Yeah, exactly. These borrowers, self-employed and or investors, they still have to have, equity into the deals as far as down payment, assets. We're asking for reserves. The qualifications on these, it's not your typical way of looking at income, as far as pay stubs or tax returns and so forth. We're looking at bank statements, and so it's that's why it's called non-qualifying mortgages. But so I've staked my claim to here because I think this is where we're going to be able to help a lot more borrowers, especially as rates. We've come out of an incredible, low interest rate cycle.
Yeah, we have.
Will it go straight up? I doubt it. It's probably going to stay fairly decent for a while. But as it's come up, the refinance boom will slow. Purchases will be a lot more competitive, and therefore I think you'll also see a lot of folks looking to do interest only or take, as we just closed the loan for you guys over there. We were talking before we got on, doing cash out. Pulling some of the equity out of their home, whether it's life events or whatnot. But home appreciation has done very well. Pulling some cash out to either even buy. We have a lot of folks buying more investment properties. So pulling cash out of their investment properties or the property, and then buying some investment properties with it.
Now, talking to a bunch of real estate agents, as I always do, they're still lamenting that it's still 5 to 10 different offers per every deal that they try to get into. Are you seeing this as the issue there too? That most of your deals are coming in having a result of having to overpay for what the market is telling them the property's worth?
You know, I've seen a little bit of that with respect to, that's where I partner with some really key appraisal management companies.
Okay.
And have my loan officers run. They give a free comp check up front, so they have a better understanding.
Oh, that's a good deal. Yeah, no, that's a very important tool. Yeah.
Because to your point, you get into these bidding wars.
Yep.
And it pushes the market up, and then you have an appraiser go out, and sometimes it's not quite as supported. So, you want to be careful on that. You want to always know and be a resource to your borrower, and the best way is to have these tools and direct access to these the key appraisal management companies that kind of know what they're doing, can give you information up front. I think it helps the borrower be in a better mindset and a better position going into it, and then they can strategically write up negotiations and contracts, and then we're able to finance them, quickly. That's one of the things where we're setting ourselves apart from others on purchases. Our turn times are significantly faster. So, if you're competing with somebody who might be coming in with an all cash or behind you with an all cash offer, the key is getting that loan closed quickly for your borrower. So that's
absolutely. Hey, Kurt, we're up against it. Can you tell people how to get in touch with you, the best way, especially if they want to talk to you about some of these great programs?
Yeah, absolutely. You can always call me, 206-696-1647, or shoot me an email. My easiest email is KL. My name's Kurt Lehrman, but KL@loganfinance.com.
Kurt, thanks very much for coming on. Great, as always. Good information, and obviously timely as well. Thanks very much.
Perfect. Thanks, Jeff.
Thank you. That's Kurt Lehrman from Logan Financial. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
Listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You can hear us, see us, and you can even visit us if you want to come into the office. We have offices all over in terms of states that we work in. That's Malibu Funding, the sponsor of the show, the company I work for. Really appreciate what they do. MalibuFunding.com is their website. I'm Jeff Barton, by the way, and thanks again for listening, tuning into the show. Podclips.io. Haven't talked a lot about it today, but I wanted to. If you have a need to hear things in one place, i.e. you've got questions about health, you've got questions about exercise, about finance, about intimate relationships, all kinds of things that you would like to hear on a podcast, Podclips.io is a central place where all of these things and many more are there. I am in the financial section. We talk a lot about mortgages. There are other people, stocks and bonds, banking, all kinds of things going on there. So go to Podclips.io for your Podclip needs, podcast needs. Let's see, what else? What else, Daryl? What else is going on in the world here? I can talk about so many things. How about you?
There's so many things that are happening. It's just mind-boggling sometimes at the speed that information gets around the world.
Well, you know, the interesting, and you bring it up, one of the things I talk about often is communication, how people talk to each other. What you listen to and what you read really affects your thinking. I try to only listen to very calm, nondescript spa music on a daily basis driving to and from work, just because I like a clear head when I get to work. But when you hear mortgage information on this show, you're hearing it from the mortgage mouth, I guess. I've been in the business about 20, 25 years. All the people that I bring on the show from a banking or a lending standpoint, been in the business a long time. The business is changing. But is it changing so much that it's going to affect hugely? The answer to that is no. It's going to be slower, a lot slower.
Well, the thing is, people have changed where they go for a news source.
Yep.
I personally still like to watch a nightly newscast, one of the networks, although one of the networks is owned by ABC and does a bunch of Disneyland coverage, but that's a whole different story.
That's funny.
It turns
you
out
say that. That's good.
70% of people at this point say their main source for news is Facebook.
Unbelievable. Do you go on Facebook much?
Not as much as I used to.
You know, it's supposed to be an old person's thing, right? I guess we're too old.
Yeah, too old. Yeah.
You know, it's maybe in the middle. Those people from age 35 to 55, they're the ones driving Facebook. I have an account. Usually when I go on there, I'm very snarky with people. I don't mean to be, but because I think the whole thing is silly anyway. I think,
No question.
most of your information through reading, through looking at many, many different websites, as well as, reading the newspapers from the New York Times to the Dallas Times. I mean, it's just, you have to go to a lot of places to get information about what you want.
Well, no matter what your opinion is, you'll get attacked by somebody for it.
Absolutely. That's why when I'm sharing, it's usually a joke. And it's usually, the joke would be on myself. So, are they going to agree with me? Well, that's fine. But I'm not trying to make fun of people or anything like that, especially online. It's just because it stays there forever. So there's no reason to be controversial, especially when you're in a business like I am in the lending business, where you're trying to solve problems and help people. You certainly don't want your personal beliefs to dictate who wants to work with you and who doesn't. I want to work with everybody. I'm an equal opportunity person when it comes to lending, especially in many of the programs in poorer neighborhoods. Certainly the jumbo loans are terrific, and we all like doing them because you make more money, right? The bigger the dollar volume, the bigger the commission. However, in the low end of the market, where we do probably 30 to 50% of our business, those people need more help because they're the ones trying to bust into the real estate market. We talk about all the time about the difficulties that people have either with the appraisal because they're in a poor neighborhood, or that they're shown different properties because they're of a certain ethnic persuasion. It's just wrong. All of it's wrong. So in trying to get to those people and help those people get into the mortgage, get into a mortgage so they can buy a house, you own property, that's how you're going to get ahead in America. Legacy wealth is about owning property. And what do I mean by legacy wealth? I mean wealth that you have that you can pass on to your kids, your grandkids, or have a house that they don't have to pay a mortgage on a monthly basis. That's a big deal. And there's probably, many, many millionaires have done so through property acquisition. And that's just the best and easiest way, because you're going to be in that house anyway, and paying it off for 30 years is like a blink of an eye. I've done it. It just happens so quickly. You raise a family, you go to work every day, all of a sudden 30 years is over and you own the house free and clear. That is a big deal, and a lot of people, that's a goal for their life so that they can, and we all who are parents want to do it. We want to leave something better for our kids than we were left. And for that, it is in the mortgage.
Well, a lot of people keep looking back. They want to go back to the way things were before COVID, before this. It's never going to be the same again.
No.
It's never going to be the same.
Like 9/11. Never going to be. You're never going to get on an airplane where you don't have to go through a metal detector. You're never going to get on an airplane where you don't have to take off your shoes first and go through some kind of security checkpoint. It's just not going to happen.
Well, over in your neck of the woods right now, a lot of the restaurants were able to survive by setting up these patio dining areas.
Right.
They're taking them away now.
Well, and what's the deal with that?
They're taking them away.
Why?
Because they were a temporary thing.
Oh, is it supposed to be temporary?
Yeah, and now they're
making them. I happen to love the outdoor dining,
Yeah,
even
me too,
in any market, in any sense. It's just I enjoy eating outside. Anyway, okay, so let's get a couple of things last that I haven't gotten to within my news to use section. Okay, the demand for goods, the supply shortages, and the dance between growth and inflation. All three of these things are about what's happening in inflation. We talked a little bit about it earlier in the show, but the speeding of taper, the making of the mortgage-backed securities and treasuries be finished more quickly, and the 3 interest rate hikes in 2022 has spooked the market. Although it was priced in, we saw the actual stock market fall a few hundred points several times this week. It came back, as it has been, on this yo-yo up and down. One day it's good, one day it's bad. And one of the things why I talk about the stock market on a mortgage show is because a lot of people have their money in stock markets. And you may not realize you have, but your 401k, your company-derived retirement benefits, a lot of your insurance funds, they're all in the stock market. And so as the market goes, so does all of these securitizations of your life, whether it's your insurance company or whether it's other things that are heavily invested within the stock market. So if the stock market crashes, it chills a lot of people's willingness to spend money on a down payment for a mortgage. And so if you're one of these people who are like that, I know tons of them who are planning to buy a house. They don't care about the price. My job's good. Interest rates are good. If the stock market gets getting upset, they start looking at their long-term retirement goals and say, oh, I can't spend money on a down payment on a house right now and get a mortgage payment. And that's a bad thing, because I think, unrealistically, we've put so much faith in that stock market, and again, up to 35,000. Daryl, after the crash of 2007, the stock market was at 7,500.
Yeah, no.
It's gone up 5 times since that in less than, 12 years, 13 years?
It's been crazy.
It's been a crazy run. And a lot of people with their house that they've got equity in, also with their, whether they realize it or not, their stock investments have gone way up, feeling good about themselves. But again, when we talk about inflation, we have to also talk about stock inflation and why that inflation is, it's never looked at as bad. If you bought at 1 and it's now 10, that's a pretty good investment. But that is inflation. And that's what the money has done in the stock market. We used to have valuations, for instance, in the mortgage business. A valuation is, what is your company worth? And if it was going public, what would we say it was worth, and how would we price the stock and we had several companies this year go public, right? Whether it's Quicken, whether it's United Wholesale, whether it's Lenshore, all these companies went public in the mortgage space. How they figure it out, how they decide what your company is worth, very, very important on the valuation. We used to have valuations 2, 1.5%, 2%, 2 times. So whatever you made times 2, that's what your company's worth. Now, companies are 100 times, 1,000 times. Look at Apple and see what their cap rate is. And the reason it's that way is because their multiples are through the roof. Anyway, all of this stuff is important, and it's important to realize that it affects you. Watch it, because it's going to affect the mortgage interest rate and the demand on what that money is. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hello, everybody. Welcome back to the show. I'm Jeff Barton, your voice in the mortgage industry. I can't even say it. Our industry, our show is available whenever you need information and you need it right away. Fit your busy schedule. We make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud and The Mortgage Voice and The Mortgage Minute, as well as weekly programs always available at YouTube. Go to YouTube. YouTube's great, by the way. If you just mortgages or different types of mortgage products, you can find it all over. And certainly our program counts as one of those programs. You can check out the blog that I have, which we keep you updated with the very latest mortgage news. Check it out and bookmark us. That's themortgagevoice.com. Great. Thank you for listening. Thank you for tuning in each and every week. If you listen more than once, if you listen for a month in a row, you'll see that what I talk about is the trends in that week, and we try to put them together in a macro as well as just talk about what's going on today. So let's get to that right now in the News to Use section. Mortgage interest rates. Let's talk about it. 3.18 is the 30-year fixed, 2.54 is the 15, 2.75 is FHA, and 3.08 is the jumbo, 3.33 is the 5/1 ARM, and the 10-year yield is at 1.43. Now, we have talked to you about that yield ad infinitum. I don't even know what that means, but it's a Latin word that means all the time. And why do we talk about it? Because that's what we look at when we're talking about what are the rates going to do. What are they doing? Where are they now? And if they go here, what happens to the rates? So this yield on treasuries, on the 10-year, that has always been linked to the mortgage rate. And again, we'll talk about it and talk about it and talk about it. So what is up with this 10-year? And why is it at 1.43? And why isn't it at 2? Why isn't it at 0.43? What happens with demand on the product itself? So if we end taper, we have all been expecting that 10-year yield to rise. Now, it's been at between 1.4 and 1.7 for the last 6 weeks to 2 months. Prior to that, it was lower. And last year, of course, it was a lot lower. When the Fed was buying mortgage-backed securities and treasuries through the quantitative easing, that was artificially holding the rates at a low place. And you couple that with the fact that at time to time, you would get a massive influx of foreign dollars because whatever issue or craziness is happening around the world, people fly to the U.S. Treasuries in times of uncertainty, just because they've never defaulted and they always pay up. And even at 1% or 0.5%, it's better than losing money in some of these other places. So all of this meant that 10-year kept getting lower and lower and lower. So what would happen correspondingly with the mortgage rate? Same thing. So what's happening now? The earning taper, right? We're all expecting the 10-year yield to go up and the mortgage rates to go up as well. But that hasn't happened. And as I stated, there are a couple things going on in the world, which means that foreign dollars flowing freely to the U.S., to the U.S. Treasuries, and I'll just name a couple of those. Let's talk about the Omicron. I guess that's the big one. When that hit, or it hit the public, I guess, knowledge sphere, if that's even a thing, when the world got wind of Omicron, let's say it was a month ago, what we saw was many people, the stock market got crunched. I don't know if you remember, it was a 1,000-point loss in that one day. Now, stock market's a crazy thing, and that's a whole different set of issues as to why things do what they do on that particular exchange. However, on that day, the stock market went down 1,000, world equities went down hugely, and what did that really do to money that was sitting around the world waiting to be invested to the best place that it could make money, either in the short term or the long term? It flooded into the treasuries, and that lowered interest rates. And that's what happened. What we saw is we were almost at 1.7% on the 10-year yield. As soon as Omicron hit, well, now where are we? We're down at 1.43. So it dropped a quarter point. Now, maybe the quarter point on $100 isn't so much, but try $100 billion. Yeah, that's a big chunk of change that they just saved themselves, or have lost rather, because the rates went down, and they went down because foreign money rolled into the U.S. at an unbelievable rate because of Omicron. They wanted to get a safe haven for their investments. Here's another one. Russia and Ukraine. I don't know if you keep up with this stuff, but in the international front, and we'll hear about it from time to time, right? It doesn't really sit on the front burner. Although, if you go to those places in the world where this is happening, it is all you think about, because war has a tendency to drive money to safe havens. During World War II, Switzerland got the bulk of the money, and it was because of the Swiss banking laws. It was all done without knowledge, or they're still uncovering stuff in Swiss bank accounts that was stolen back in World War II. So, money flowing to the safest harbor during troubled times. So in that part of the world, that's what's happening. And if you also look at what's going on with Evergrande, Kaiser, and Shimoa, as well as 11 other building companies in China, and the defaults that they're experiencing, and what's happening to the Chinese economy. We're seeing a shrinking of the Chinese economy like we've never seen. For the past 10 years, we've seen 10% GDP per year, and that's average. Probably some years, 15, 16%. But because of what's happening, obviously with Omicron, but more readily because 25% of the market, 25% of the Chinese economy is within this building sector, and they've had the largest building boom in the history of the world happen in the last 10 years in China. Those companies that borrowed heavily in order to build are now, the bills come due, and a lot of them are defaulting on the bonds, the dollar bonds that they have, that especially foreign bonds, and how that has affected the marketplace, both here in the U.S. as well as around the world, driving more money into the U.S. Treasuries. So these three items are just three things that have really driving prices of Treasuries, and obviously the mortgage market that follows. There are many other things that affect, but these are some of the things looking at that I say, okay, let me look at the market. Where's it headed? So given that being what it is, are we going to see rates rise or fall? Okay. I think for the short term, we're going to see them rise. I think if China is really what it it states to be, and meaning that this sector is going to crash, although what we've seen recently is that although there was a crackdown on monetary policy and tightening of credit to these companies, the overall Chinese market is getting a loosening of credit, i.e. borrowing more money more easily, i.e. keeping the growth rate of what's going on there intact. And that growth rate is very similar to what we're trying to deal with in the U.S. We're going to raise interest rates too. We're going to end tapering. And so the Fed, Chairman Powell, who has been renominated, has this balancing act, like they do in China. And why this drives the markets crazy is because those people aren't omnipotent. They don't know any more than many, many different people with different opinions. It just has the authority by which they can act. And that authority says we're going to do this balancing act, this tightrope act between inflation protection and growth. You have to have good monetary policy for growth, yet you can't let it too loose to be able to keep inflation under control. Now, when Paul Volcker was around back in the 70s, the Jimmy Carter days, 18% to 20% inflation, Jimmy Carter, Richard Nixon, really. And Nixon was the one who started it. Anyway, regardless, he was the one who said, okay, we have to raise interest rates to stop inflation. It was the number one job of the Fed. Now it's going back to the number one job. And that was a quick turnaround, too, by Powell. Quick turnaround. So all of these things mean that borrowing may become more expensive. Unfortunately, we may see 4.5% interest rates by the end of next year. We may see treasuries nearing 2% by the end of next year. If that happens, I think the markets would be happy about it, because I think that's predictable and what they call priced into what they're telling you and having you pay for. Anyway, those are the things that are important in my world and in your world too, because following it, you can really trace where the interest rate rise is coming from. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.